Well, we're at 2. So yeah, I think we just let's just get after it here. So right on. Welcome everyone to the Understanding Shareholder Loans. What do I owe my shop versus what does it owe me webinar. We're happy to see everybody here and looking forward to getting after this today. So some intro and housekeeping that we got going on right now. Firstly, welcome again. Thanks for being here and we're happy to have you. The session is being recorded. Your microphone is muted and your cameras are not on. Pretty standard for webinars of this nature. The session will be approximately 30 minutes with a 15-minute Q&A at the end. We do want to be cognizant and respect people's time. I'm going to be hanging around for a bit afterwards, so if people want to stay a little afterwards and shoot questions and whatnot, that's cool. But we're going to try to keep this to 45 minutes. And please use your Q&A tab at the bottom of your screen if you have to ask a question or you want to ask a question, by all means. All right, so today's host, myself, Bryan Machacek, CA, CPA. I'm Director of Moneywrench here. We also have Murray Voth with us, President of RPM Training. Very happy that Murray is with us. Murray.
Hey, everybody.
And in behind the scenes, we've got Caitlin. She helps me out a lot with our Moneywrench and what we're up to here. So she's monitoring things on the back end for us today.
Fantastic.
All right, so we're going to be talking about a few points here today, certainly, and I want to set the stage here. And you know, if I go back a number of years, I was a tax guy. Well, I still am to a degree, and we always were drawing our nice little pretty pictures. So I'm going to walk you guys through. We're going to watch a little bit of a video here to help set the stage.
Hey all, yeah, I'm gonna do a quick video today to help illustrate and set the stage for the webinar here. And you know, today we're going to be referring back to a company called Bryan's Auto. Bryan's Auto Shop and Ltd. And Bryan's Auto Shop is owned by Bryan and Jacky. 50%. 50%. A couple of years back, I got a hot tip from a friend of mine saying, if you got any extra money laying around, you better buy some Amazon shares. So I did. I bought 10 shares of Amazon. You know, represents 0.00000001 ownership stake in the company. Amazon is also owned by, you know, millions of other shareholders, whether those be individuals, investment holding companies, trusts, mutual funds, etc. So, very closely held corporation, Bryan's Auto Shop Ltd. And a big public company, Amazon. This is a Canadian-controlled private corporation. Here we got a public corporation. But in both situations, we have this line in the sand, or this veil between the corporation and the personal or the shareholders. That veil does a lot of things. From a legal perspective, it generally provides a layer of protection. You know, but underneath the line, I guess, if you will, Bryan's Auto Shop and Amazon, they're their own separate legal entities. They can buy, they can sell, they can transact, they pay taxes, etc. The big difference here, however, is that in the closely held Bryan's Auto Shop, you know, Bryan and Jacky have the ability to just dip into the bank account whenever we want. Oh, geez, I need 20 grand to go on an awesome Hawaiian vacation with the family. Oh, I need $10,000 to, you know, do some renos or put some new carpet in the house or in our personal house, for instance. You know, contrast that to the Amazon situation where, you know, I'm not just going to be able to pick up the phone and call my buddy Jeff there and, you know, hey Jeff, I need 20 grand, you know, for some stuff, for some things that I want to buy here. So can you just send that to my bank account, please? You know, because I'm a shareholder in Amazon. It's not going to happen, right? So, you know, that's what I wanted to get across is that even though we've got very closely held a corporation, we do really want to be thinking about Bryan's Auto Shop in the sense that, you know, it's its own entity. You know, we want it to be profitable. We don't want to just be treating it like it's our own piggy bank. And unfortunately, we see that happen quite a bit in small owner-managed businesses. That wouldn't happen in the Amazon situation, for instance. Okay, hopefully that helps illustrate the concept there and sets the stage for Bryan's Auto Shop and Bryan and Jacky as we proceed along here.
Okay, yes. So Bryan's Auto Shop, Jacky, that's my wife. I'm going to pick on her a little bit today, so she's aware of that, and she's fine with that actually. So which is you know, she's good-hearted in that respect. All right, today's objectives: establish some common language. We're going to understand money in, money out, understand tax implications, tips and must-dos. And we'll wrap up with and then an exclusive Moneywrench offer, and then we'll have the Q&A session. All right, common language. So in our world, in the accounting world, dividends gets tossed out a lot, draws, wages. Dividends. Well, that's what's paid to shareholders out of a shop's profit. It's the equity. The shop makes its money, it pays its taxes, it pays its expenses, it has retained earnings or a profit there that is sitting accumulating from day one of the company, and dividends are stripped out of that. Draws are just simply straight out of the company's bank account effectively when you take the money out of that bank account, and that's a balance sheet item. Wages are what we're paying ourselves for the work that we do for our shop. And or you know, if we consider ourselves an employee, which many owner managers do, and we're exchanging our time, our labor for money, and that's a profit or loss item. All right, money in and money out. Great way to think about these shareholder loans. So money in, your shop needs cash to operate. For an auto shop business to run, or any business to run, it needs cash. And just some common places it sources this from. Well, it sells its services, it sells parts, it sometimes might sell off old equipment, maybe not necessarily something that's common in an auto shop, and in other businesses certainly it could be more capital intensive businesses like farms would sell off old equipment. It'd be a big part of sourcing cash. Operating loans, term loans, mortgages and bonds, could source cash from leasing or issuing common shares or preferred shares. We don't really see that much in an owner managed situation, but it's out there. And loans from shareholders. We call this the capital mix overall. So a loan from a shareholder, well, when the shop needs cash for something, it's quite common that it will ask its shareholder. Well, it doesn't really ask its shareholder. The shareholder in an owner managed situation, well, it might ask its shareholder. But in an owner managed situation, you might be sitting there going, geez, the shop needs some cash. I got some laying around. Here shop, have 20,000 to do what you need to do. So that's when we come in from a loan from a shareholder. So where do we get that as a shareholder? Where do we source those funds? Well, past savings. Maybe I've saved up in my tax-free savings account and I got $50,000 sitting in the tax-free account that I could inject into my shop. Maybe I got some inheritance money from a grandparent or what have you. I might have a HELOC or a bank account, or HELOC or bank borrowings personally. So, you know, quite common HELOC, home equity line of credit. Maybe it's 100,000, 200,000. You've got the ability to pull that money personally and inject it into the shop. Friends or others, you might have people who want to lend you some money, or parents, friends willing to lend or give you money to use in your shop, to inject into the shop. So how cash in usually works? Well, we transfer money into the shop bank, and we use that money to pay for shop expenses, wages, buying equipment, just general expenses, rents, etc. We keep track of it, or we should. I got question marks there because a lot of times we don't do a great job of keeping track of it. Paying interest to the shareholder, or we don't. A lot of cases, or the majority of cases, we see we don't pay interest to ourselves. We pay interest to the banks. They certainly want their interest, but we're not necessarily paying it to ourselves. If we do pay interest to ourselves, we should be following that up with tax slips, the T5, for instance. We pay back that money when it's available, and we rinse and repeat that as it sometimes happens, and depending on the shop needs, etc. So Murray, you and I were chatting a little bit earlier last week, and you had some comments on this particular slide.
Yeah, one of the common things I see is shop owners doing relatively well, and they're looking at an expansion, and the company itself doesn't have as much cash to add that extra bay, or maybe they need a new hoist. Usually has a larger capital expense, and so they try to source money, and they find that banks won't talk to them, or it's a unique situation with really high interest, and so they decide to add another mortgage to their house to source the money to put it back into the company. And along with what you're saying there, is what I find is that it's usually done informally. It's not necessarily tracked very well. The company pays it back when it can, and then back to that interest piece. And I want to tie that to a comment from your previous slide. When the company needs money, we source it from various places, like an inheritance or like a loan and from family. And very troubled quite a few years ago, working with a shop who had borrowed money from a grandfather, for something, a large capital expenditure, something like the business, or they hadn't been making a profit. And, this gentleman put a good chunk of his retirement into this business, and the kids were not paying it back. And where I'm coming from on this, Bryan, is a lot of shop owners, technicians became shop owners. They're not understanding profit per se. They're like, as long as I can take a paycheck, or as long as I can take a bit of money home, I seem to be doing okay. But they're not realizing that we need to be making a profit so that we have the cash to pay our loans back. But also, if we loan it ourselves, that we have the interest to pay the return on the investment of that money. I mean, if you were to take that same $200,000, like now you're borrowing it, you're probably paying 2-3% on it, borrowing it against your house. Why not pay yourself 5 to 7% interest as a business out of the profit? So part of this whole thing is just really about profit is a good thing. It needs to be part of it. The same way Amazon shareholders would expect Amazon to pay them dividends, the shop owners need to. And I think that's a mind frame that this is addressing here.
Yeah, exactly. Yeah. Exactly. That's a great example of and some good common practical experience there that you've seen over the years, for sure. And we see that as well. So cool. All right, let's shift to the money out perspective. So we all need cash to live. Ultimately, as individuals and shareholders, we need money to buy what we need, groceries, for example. So where do we get that? We trade our time and wages for labor for wages. We might have money that we've loaned out that we were just talking about there. Maybe we've loaned it to a business associate or somebody we know, and we want some interest and some points on that money. Dividends, again, whether it's coming from Bryan's Auto or Amazon. Selling your property, maybe I bought that boat a couple years ago that the kids really wanted, and they don't really want to use it anymore. Now, a boat is probably a bad example. My kids would love a boat, but I have seen situations where people have bought boats, maybe overextended themselves. Now you're selling it to get some cash. Borrowing from banks and borrowing from others. I put the Lotto Max Lotto 649 in there because surprisingly that's a dream for a lot of people, but I think a lot of people have that as plan A, actually. And the borrowing from their own shop, borrowing from their own shop or their own business, that is quite common, and that's what we're here talking about. So loans to the shareholder from the business. When the shareholders of shops need the cash personally, over and above the regular wages or compensation they're taking, it's quite common to draw on that shop's cash. Sources of the shareholder draws. So the shop needs cash. It's going to source that cash from its profits. It's sold its labor, it's sold parts, and it's paid expenses, and it's had a net income or profit, and that sources cash to me. Maybe the shop has borrowed money from the bank. Maybe it borrowed $100,000 and it only used $50,000 to purchase some equipment. an extra 50 went into the general bank account, and voila, I pulled that 50 out to myself. Or other debts or loans. So recently we've had some, well, we've come through the COVID. We're still in the COVID situation here in Canada and the world, but we're coming out of it, thankfully. Looking forward to that. But here in Canada, there's been some big programs, the Canada Emergency Bank Account, for instance. You know, if you took the majority or took that full advantage of that loan, that's a $60,000 injection of cash into your company or into the shop. And 20 of it's forgiven if you repay 40 by the end of next year, December 31st, 2022. Well, you know, that's an injection of cash. Where did it go? We don't know, but that's another way or means that the shop might be able to source money that we can then, or we then strip out to ourselves. So here's where I'm going to pick on Jacky a little bit. So Jacky's a shareholder of Bryan's Auto, as we talked about earlier. She needs some money. I won't really say why. Well, it's because she loves shoes, and she's got a couple closets full of shoes. So she wants to buy some more shoes. And hey, the shop has some money. And she draws money out of the company or out of the shop to buy those shoes. And well, she did it again and again and again. And then at the end of the year, the dreaded accountant comes. He's sitting me down saying, "You took too much money, Bryan." You know, that's not that particular example, you know, I'm picking on Jacky a little bit, but where we're going there is that it's quite easy for us to take $20 here, $20 there, 500 here, and we don't really realize how much we're actually doing. You know, so you're probably looking at your books, and, you know, or this is a common thing that we see. We try really hard to work with our clients to avoid this situation, but you know, you might have been here going, "There's no way I took that much out. There's just no way," and wondering how that happened. So this could have been you. Maybe it was you this last tax year. So how things usually work, right, in the money out method? Well, we transfer money to our personal bank. That could be a direct transfer. The shop directly pays for personal expenses. You know, I use the shop's credit card to do something personally and just run it through the card, and I don't have to deal with that for 10 months because that's when my year end is. And so why deal with it today? I'll look at it 10 months from now. We don't keep track of this, or we do it poorly. Again, that's what we're trying to avoid. We want to be knowing where we're at all times, but a lot of times we don't see that, unfortunately. We're not paying interest back to the shop. So we've borrowed from our shop, but we're not paying interest back as a personal shareholder. The accountant tells me how much I took at the end of the year, and now I'm frustrated because I didn't realize it, and I didn't know that I needed to pay 50,000 back or whatever that number is, and I got to pay it back somehow eventually. I just don't know how that's going to happen, and it just happens over and over again. I repeat, and I'm always in the hot seat, always feeling that pressure.
That's the reason for this webinar. Bryan and I, after we met, started talking about this, how common it is in automotive shops.
Yeah, exactly.
It's really common.
Yeah, you know, and we're hoping to educate and help understand and get this under control, because it is a problem that happens out there more so than you'd hope.
Yeah.
All right. So here's another little video that I'm going to put forth here regarding walking through an example of this, what we're all talking about here.
Hey everyone, we're going to go through a quick example of a shareholder loan under using the Bryan's Auto Shop Corporation. So Bryan's Auto Shop, it was incorporated June 1 of 2020 in this example, and its fiscal year end is December 31. The period we're going to be looking at here is really June 1 of 20 to December 31 of 21, and we got sandwiched in there a December 31, 20 year end. Okay, So again, keep in mind, we are thinking about this from the balance sheet of Bryan's Auto. So in Bryan's Auto on its balance sheet, there's a shareholder loan account for Bryan and Jacky, really. Well, probably two, actually, one for Bryan and one for Jacky. So let's just say this is Bryan's. Okay, so on June 1 of 20, I had some money sitting in my TFSA. The shop needed startup capital, so I took 20,000 out of my TFSA and I put it into the company. 20,000. This is Bryan startup capital. Now there's $20,000 in the company bank account, Bryan's Auto Shop company bank account, and the company owes Bryan $20,000. This is why it is in brackets. It owes me. It's showing, reflecting the payable owing to Bryan. Then on November 15th of 2020, Bryan pulls 10,000 out. This will be December 31 of 2020. Bryan pulls $10,000 out to pay for some home rentals. Let's just say some home renovations. So as of December 31st, 2020, those are the only transactions running through my bank shareholder loan account. Bryan's Auto still owes Bryan $10,000. Then let's say on June 2nd of 2021, I pull $20,000 out of the bank account, and that is to do the final install on the home rentals. And nothing else ran through the bank account or the shareholder loan account. Well, if I get to December 31 of 21, I now owe the company $10,000. It's a positive number in this example because on the balance sheet of Bryan's Auto, Bryan, the shareholder, now owes the company, and it's really a receivable from Bryan in this example. So I started out, the company owed me 20. I took 10 out at December 31st, 2020. The company still owed me 10. On June 2nd, I pulled 20 out. At the end of the year, December 31st, 2021, I now owe the company 10, and eventually my accountant is going to go, bad, Bryan. And he's going to tell me I got to do something with that. Okay, hopefully that helps explain and illustrate just a quick example of the shareholder loan and how it tracks and moves. And again, it depends on what you got going on in your shareholder loans or what shareholders do utilize corporate cash for and the ins and the outs. But that's a quick example of just the flow of a shareholder loan using some relatively practical examples.
Yeah, so that was a fairly simple example there. A lot of times it can get much messier depending on what's running through the account, but wanted to show and lay out how over time we're tracking that, and really it could be a daily thing, depending on what is running through and what you're using your shop and your shareholder loan for.
Can I give an example, Bryan?
Absolutely, for sure.
I'm at Home Depot buying a snowblower. I've got money on my personal credit card. I got space on it, and I go to use it, and the stripe it's been demagnetized, and my personal credit card won't work. Well, the sale's on now on the snowblower, so I just pull out the company credit card and I buy the snowblower with my company credit card, thinking, oh yeah, at some point I'll go fix that all that. And of course, snowstorm comes, blow the snow, and now that $1,000 snowmowing bill is now a shareholder loan. So it's little things that happen to us that we just as small as a credit card not working and switching to the company credit card is right away $1,000 on the shareholder loan. I mean, it could even be a $20 screwdriver, right? For goodness sakes. And that's just another example that happens to people, right?
Yeah. For sure. That, if you know me at all, you're going to know that I just despise utilizing corporate cards personally and personal cards corporately, and vice versa. That's just, you're just setting yourself up for bad news in that case. So when are we typically discussing this again? It's generally at the year end with the accountant or bookkeeper, not all the time, but that's certainly the time when it's going to happen. In many cases, we as shareholders might not know, or not even aware of what's happening. Why does the accountant care, your accountant? Well, ultimately, the Income Tax Act has provisions built inside of it to allow us to do this, but only for so long. It's about a year. Well, it's technically a year after the year I took the draw out of the company. So we don't have forever to do this. I can't take 20,000 out of Bryan's Auto and just park it on the balance sheet and sit there forever. If I do that personally, I'm going to have to deal with that eventually, and I only got a short amount of time, relatively speaking, to do that. The penalty here, if you don't deal with it, and why the accountant cares so much, is because the CRA, if they're reassessing you, will push that back to the year you took it. So now we're normally a couple years out, and we're getting a reassessment on personal taxes going back a couple years, reassessments, grief costs, getting those brown little letters that nobody likes to get, and interest and penalties. So again, this is why your accountant really cares at year-end time, but we really should be caring about this all the time, at least, monthly, tracking, knowing where you're at.
No. One of the things that we were chatting about earlier, Bryan, on that slide, I'll just take 20 seconds here, is the $20,000 that I lent to Bryan's, or that you lent to Bryan's to start the company can take forever to pay that back.
Yes.
The rules are different, but as soon as you take the money out, you have to pay it back within the year of taking it. So people get that mixed up, right? So
exactly. If the company or if the shop owes me, and it can sit there and have that in perpetuity, but if on the reverse side, if I owe it, I've only got that short time period.
Yeah.
Okay, well, tips for the growing auto shop. When we think about it, let's just walk through this quickly. Having real-time data. So in our world, real-time data, knowing where you're at constantly, daily. Accounting isn't a monthly thing. It's a daily task that needs to be done. Knowing where your loan balance is. Again, too many stories over the years of people not knowing, not tracking. It's easy for 6 months to go by and we don't realize what we've done and what we've taken out of the shop. Planning our dividends in advance, planning our compensation and remuneration in advance, always a good thing. Paying yourself what you're worth. Murray, you touched on it earlier regarding just wanting to make sure that we're paying ourselves what we're worth and what the shop is actually owing or should be paying us as the manager or what have you. I believe, a lot of times profit or loss statements get beefed up by the fact that we haven't run wages through. And you need to be looking at it going, if I was not in the shop, if I was not here, what would I be paying somebody to do what I'm doing?
Exactly. Yeah.
Paying interest on our loans. If we've loaned money, the shop should be paying interest on the loans. Planning our tax installments early. Certainly, that's never a good thing in April when we got a bunch of tax to pay. Watching the bottom line. Always be watching that bottom line, not just our margins up top, but the bottom line as well. Building that annual plan out, knowing what we're doing over the next period of time, setting targets, setting margins, and setting the KPIs, which is what you work a lot with your clients on, Murray.
Yeah. This is a great slide.
Yeah, it is. There's lots of tips in there for what you should be doing as growing a healthy shop. All right, well, we're getting up to the 30 minutes here. So how do we help grow healthy auto shops? What we call our Moneywrench scorecard. That's our monthly analysis tool that we work with clients on. We provide our financial statements that make sense. I've seen too many financials over the years, literally thousands, and a lot of them don't provide the right data. Clients don't understand what they're looking at. We help you reconfigure financials into something that makes sense. Understanding that balance sheet, that's a big one. The profit or loss statements more, people tend to understand that one more than the balance sheet, certainly. Finding that correct capital mix, setting targets. We're watching the books, so you don't have to. Monthly providing information and analysis to you, creating and agreeing to that annual plan. And I mean, that could go on and on there, but our mechanic accounting system package for auto shops, that's really what we do here at Moneywrench. And Murray?
Well, I'm so excited to have met Bryan, because it's an accountant who's the closest accountant that I know that can speak to a technician or a mechanic. And the vision of simplifying things and putting things into words that we can all understand. So I love that. I, of course, having been in the business myself and then now coaching, find that most aftermarket shops are started by technicians. They want to have control of their destiny. They want to be their own boss. They see that there's an opportunity to make money. And then most of them, a few years into it, just don't achieve the results that they thought they would achieve. And so that's where I bring in systems and processes. And, at the end of the day, as simple as, we were talking about this yesterday with some of my clients, charging properly for our parts, having a proper gross profit margin, that profit pays for expenses, including our salary, right? That we can pay ourselves. And I think if a shop owner has a regular paycheck, they will not dip into the piggy bank the way they dip, right? They think it's just a little bit here and a little bit there. And they say, you know what, I won't take a paycheck because my company will suffer if I take a paycheck. So what I'll do is I'll just take money out as I need it. And then at the end of the year, they're just absolutely shocked by how much they took out just because it was in such dribs and drabs. So that's another common thing, Bryan, is I think a profitable shop with a regular paycheck reduces this problem as well. So,
yeah.
So guys, I got to run. I'm getting my second shot and I just got to go drive to the clinic. So I'm excited about that. I'm going to leave you in Bryan's good hands here, and he'll answer your questions and answers, and I'll be available. They have my email address and stuff. So thanks again, Bryan. This is awesome.
Yeah. Awesome. Thanks, Murray. And we'll talk soon.
Yeah. Talk soon.
Cool. It's so great that Murray could be with us. He's a great resource out there for shops and shop owners. And so, yes, thanks for watching. So for questions, you can email us at connect@moneywrench.ca. We're here to help build healthy, growing auto shops. And right now, our offer, I talked about that earlier. The offer we're providing is our free financial accounting and shop management software alignment. So what that actually means is we are going to look at your accounting data and compare that to the POS data or point of sale software. It's your shop management, Protractor, TechMetrics, Mitchell, etc., QuickBooks Online on the other side, and compare that and show you where you're out. And it's surprising actually how many shops don't realize where they're out. And that's the free offer that we're providing today to anyone who reaches out to us from the webinar here. All right, live Q&A. It's your turn. So Caitlin, where are we at there with any questions that have come up?
Yeah, for sure. I actually have one question that came in here. I'm just gonna pull it up here real quick for you. So this one is from Andrew, and he is wondering about company loans to shareholders that aren't paid back within the year. Are they considered income by the CRA?
Yes, they are effectively. If they're so using my example there with Bryan's Auto Shop, I run a December 31st year end. So in that example, at December 31st of 2020, the shop owed me, and that can sit there forever. But then when we fast forwarded to December 31st of 2021, I owed the shop the $10,000. That would have to be repaid by December 31st of 2022. Otherwise, it would funnel back to my personal income in the 2021 personal tax year. So that's where that year comes into play. It's based on the shop or the corporation's fiscal year end, but you really only got a year to deal with it. And that repayment could be in cash, it could be a dividend that I pick up on my personal tax return. Those are the two common methods to repay it, but it's got to be repaid within that year.
Perfect. Now, I came in a little prepared here with some questions. Some people had asked before and took note of them. They unfortunately couldn't make it here today. But one of the questions I had here was, what are your thoughts on using your shop's, like your personal credit card for shop expenses? I know you kind of touched on this a little bit earlier here, and just wondering what your thoughts are on that.
Yes, let me just back over this. I Yeah, using personal. I think I mentioned it earlier in the webinar itself, but I dislike that wholeheartedly. You don't use personal credit cards to buy corporate expenses or pay for corporate expenses and vice versa. It's just not a good practice. Again, seen too many horror stories over the years of that happening, and it causes accounting grief, etc. So I would never recommend that. Try to keep that line in the sand, your business expenses and your personal expenses separated.
Perfect, perfect. Now I have another question here. My accountant has never asked for real-time data. Can you describe why that is important as an auto shop owner?
Well, again, without knowing where we're at all times, we need to. We're making improper decisions. We're not making good decisions based on our situation that's happening. We think we're doing okay. There's money in the bank account. I must be doing okay, but I'm not doing okay, or maybe I'm not doing as well as I think I'm doing because there's a pile of amounts that I owe for parts or etc. So real-time data really means, yeah, at any point in time, I'm up to date with my bookkeeping, and I need, and that we practice that here internally in our own business, as well as we want to make sure that all of our clients are doing the same.
Perfect. Now, to kind of touch on that, how often do you think that your bookkeeping should be done? Is this a 3-month kind of deal, or do you think that it's more of a day-to-day operation?
Yeah, it's really day-to-day. 3 months is too long to know where you're at. I think you're out of date if you're a couple days behind, quite frankly. To know where you're at, really it's a daily thing that you should be doing.
Perfect, perfect. And what should you do if you don't agree with what the accountant says that your shareholder loan amount is at? What should you do in that case there, Bryan?
Well, as a shareholder, I should be looking at my general ledger or diving into that loan balance and actually digging into it to determine what is that balance being made up of. So it might actually be some homework on your end to look at that number and where it's coming from, and figuring out, yes, I did actually take that, or no, I didn't. And then if it's something that could be a business expense, we need to look at that. It does actually happen, and the accountant will tend to err on the side of caution. If we don't know what something is, a lot of times we will, as accountants, run it against the loan, the shareholder loan, versus as a business expense, because you're always subjected or potentially subjected to scrutiny from CRA. So there could be situations where you just got amounts buried in there that are legit business expenses. But because we didn't really know what they were as the accountant, we're going to err on the side of caution and put it into your shareholder loan. So if you're ever in that situation, you need to really get in there and figure out what's going on and looking at the source of those transactions.
For sure. Okay, perfect. So we do have another question here that came in from Ronald Roy. He asks, who would be entering into real-time data, and is it time consuming?
So by real-time data, what we really mean is just your underlying bookkeeping. However you do that, whether it's through the cloud and a solution like QuickBooks Online, or maybe you're running a QuickBooks or a desktop software like QuickBooks Desktop or Sage, or there's many accounting programs out there, or maybe you've even got a shop software that is that tracks that inside of itself. Some of the shop softwares do that. So it's your bookkeeper, quite frankly. However that's being done, maybe it's a spouse, maybe you actually have a bookkeeper who comes in every couple of weeks or what have you, but that is the person who's on the front lines, if you will, of tracking what's happening in and out of the corporate and the shop bank account. And that's where it all starts. So the real-time data, I guess, to clarify, we just mean it's the bookkeeping that you're doing happening in real time, happening almost, well, daily.
Perfect, perfect. And I just have one final question here. This is probably going to take up the last 5 minutes that we got here, but how are dividends taxed differently to me than wages as a shareholder? Getting into the weeds here a little bit. But
Yeah. Well, inside the Income Tax Act, I suppose, or the Income Tax Act, is the scheme of the act is really such that it wants to, whoever wrote it, and the Department of Finance, whoever wrote it way back when, came up that they wanted to tax every dollar of income in roughly the same manner or roughly the same amount, regardless of how it's earned. So if Bryan's Auto Shop earns income, taxable income, and pays corporate taxes on that, and then pays a dividend out to Bryan, versus the situation where Bryan takes a wage, which is an expense to Bryan's Auto, and the company or Bryan's Auto is not going to pay tax on that. In situation one, a level of corporate tax at Bryan's Auto added to the personal tax that Bryan pays on the dividend, that amount should total the tax on the wages or equal the tax on the wages. So dividends they're tax preferential personally as compared to a wage, but when you compare or add the corporate level tax that was paid, the two equal out pretty closely. It's not perfect. The integration concept isn't perfect because our system is so complicated and there's so many things going on in behind the scenes, but at its heart, corporate level tax and personal tax on dividends is going to equal the personal tax I pay on wages.
Perfect. Now we got about 4 minutes left here. I don't have any more questions here in the Q&A section, but if anyone had any other questions or anything like that, we're opening up the floor to any kind of tax related questions or anything like that. And Bryan, I don't know if you had anything else to say here, but.
No, I'm just happy that people could join us today, and that people could join us today. And yeah, we are open and wanting to help shop owners grow that healthy business. Yeah.
So another question just came in here last minute. We got, how can you make it easy to keep your data real time? What's the easiest way that you can make that happen?
Really figuring out, it's really getting that good bookkeeper, having that good bookkeeper in place that you can trust and know and is going to help you keep up on your data and your books as accurately and timely as possible. So it all starts, everything in our world starts at that entry of transaction by transaction. So making it easy is having that done properly right from the start.
Perfect. Yeah, you got it in right at the last minute there. So good on you, Mark. Yeah, I think that's all I have for you here there, Bryan. But yeah, close it up and there we go.
Thanks, everyone. Happy to have done this webinar, and we'll see you around.